As we continue the ETF revolution, how innovation is redefining investor portfolios virtual event, it is my true pleasure to welcome in Taylor Ranney, Senior Vice President, Business Development for Rec Shares. Taylor, so great to be with you here. Such a great day.
Yeah, no, happy to be here. Excited to talk about what we're doing here at Rex and dive into some of our products. Thanks for having me.
Well, it's my pleasure and honor. Let's dive right into it. Let's talk about Rex. Tell us a little bit about it and the products you offer.
Yeah, so Rex has been around for over a decade now, and we've really had our legacy and continue to bring that forward in really providing more sophisticated products that were traditionally available only to the institutional marketplace to all advisors and all investors for that matter. It's not just financial professionals, it is your retail investors as well. So we're happy to be able to do that. And at Rex, we really have three main business lines or product verticals, if you will. And so two of those are really focused on the trader. So we have a series of micro sectors ETNs, which are concentrated baskets focused on themes like big tech, big oil, big banks that provide 3 times long and short exposure. So those are products that you certainly want or to be more of a trader oriented person for that type of exposure. We also have a partnership with Tuttle Capital Management for our T-Rex lineup of single stock inverse and levered products. We then also have a product suite that we continue to grow and build now, which is more investing focused and long-term buy and hold. So if you think things like covered call ETFs, and we're looking to expand that product suite out. We also recently launched back in March, more nuanced exposure, but it's really focused on Bitcoin corporate treasury convertible bond ETF. So that's looking to get exposure to converts from issuers like MicroStrategy who are specifically doing that and issuing that debt to raise capital to purchase Bitcoin for their corporate treasury. So some really unique exposures across the board.
It really is, Taylor. It really is an ETF revolution. That's obviously the name of the event today. It's unbelievable. Let's talk about how you achieve some of these different exposures, options, swaps. How does that work?
Yeah, absolutely. So when you think about the leverage and inverse exposure, so the ETNs and the micro sectors brand that we have, we're achieving those through total return swaps. Similarly with the T-Rex brand of single stock leverage and inverse, predominantly we're gaining that exposure through swap as well. However, some of those products have taken off and become incredibly popular. And so with that, we do supplement the swap exposure with listed option exposure. And how we're achieving that is if you purchase deep in the money options, then you can have much closer of a delta to 1, meaning that you're just getting like for like exposure to the underlying security. And you also are able to do so with a lower capital requirement just because of the options in general. Now, if you flip that, right, I mentioned listed options. We are also using listed options for our covered call products. We have 3 main flagship products right now in that space. One's focused on big tech, another focused on AI, and another focused on more of the digital asset ecosystem or crypto equity in general. And with those, we're using listed options and not flex at the moment. We do have the ability to, but it becomes a little more cumbersome when you have portfolios of 15 to 25 stocks where we are actually writing the options on the individual securities themselves. However, we did launch last week and 3 more single stock covered call ETFs today, where we are using flex exposure, flex options. And the primary reason that we want to do that is because we have more ability to really focus what we want that contract to look like. And in particular with that, we're able to have cash settled options. And that's important in case the options are called away early. We're able to do that with cash settled options. So it doesn't disrupt the underlying portfolio and the exposure. So different ways to access different types of exposures, but it's really great with what we have, at our disposal to capture these types of exposures nowadays.
Yeah, it really is. It's fascinating. And Taylor, I want to dive in on the covered call ETFs. What is it that makes them different from other covered call ETFs in the market right now?
Yeah, so we launched our first covered call ETF. It's FEPI, FEPI. It's a FANG and Innovation, big tech focused covered call strategy in October of 2023. And, the covered call universe 5 years ago was only a couple of $1 billion. Today, we have it pegged at over 116 billion. So explosive growth across the segment. But what we notice is that a lot and almost all of the major competitors and peers out in that space are writing calls at the index level. And what's really unique about that relative to what we're doing, writing at the individual security level, is when you think about options and premiums that you're collecting, the main driver of what that actually looks like is the level of implied volatility. So as you can imagine, NVIDIA, MicroStrategy have substantially higher implied volatility than what you would see at the index level, even of the NASDAQ 100, right? You're talking implied volatility of that index roughly 20%, and you can get Palantir up to 50, 60, 70%, right? So these are more volatile stocks, but what that does for us is it allows us two things. We're able to capture more premium, and I'm talking with FEPI 2.1% a month or 25% annualized. AIPI is our AI-focused product. That's 34.8 a year or 2.9 a month. And then SEPI is our crypto equity covered call product. That's 42% annualized distribution or 3.5% a month. Typically, when I bring that up with investors, a lot of the time it's received with some skepticism. Like, how are you able to do that? Are you just eroding NAV? And in reality, we're not. Looking at our monthly distributions and monthly premiums since launch of each of these products, FEPI's actually been able to supplement that with capturing premiums of over 50 basis points in addition to the distribution, meaning 2.6%, we're distributing 2.1 on average per month. Go up to SEPI, it's over 100 basis points. So these are very well supported distributions despite being so high. So that's point number one. Point number two is that implied volatility really allows us to also write further out of the money. So a lot of these bigger players are writing close to or at the money, which means your upside is being captured. Most of the time, these are 1 month expiry options, which ours are too. But it's important to be able to capture additional upside, participate in upside capital appreciation, but also, and more importantly, these are exposed to the downside. So if you have an environment like we recently saw in kind of March, April, or last year during July, August, during a tech sell-off, where FEPI was down 14%, the uncovered version of the index was down 19.5%. So we had some buffer on the way down, but it only took us 2.5 months to recover that 14% drawdown, which is incredibly important when you're talking about these higher distributions to be able to recover NAV. So we think it's a really interesting approach to capture substantially higher premiums and a higher distribution for our clients while also maintaining capital appreciation prospects.
That is pretty incredible, the numbers you just gave there. And, obviously the investors watching today, I think they're wondering, how do you want to see them, use these strategies? How should they look to do that?
Yeah. So look, I'll start with general covered call use cases. And I think, there are benefits to some of the peer products out there, right? Like, of course there are. If you're writing calls on the S&P 500 and you're an advisor, you're an investor, and you're saying to yourself, you know what, I think the market's a little bit frothy. I think valuations are a little bit higher. I still want access to equities, but I want a lower beta approach. The way that you can go about that is maybe carve out part of your large cap core exposure, and maybe it's 20% or whatever you feel comfortable makes sense for you from a portfolio construction perspective. And you're able to increase your premiums or increase your yield and lower your beta to that part of the portfolio. So it can be used as a beta reduction. Similarly with our products, if you have clients who are heavily invested in tech focused or tech forward areas of the market, you can have a lower beta approach and pull forward some of those distributions or some of the returns through the premiums that you collect. We've also seen people with our products in particular, I'd say the number one use case is really more of an income model portfolio, and it's a capital efficient way to meaningfully increase an overall portfolio yield. Right? If you take 10% of an income model, you're adding at the aggregate level 2.5% with FEPI, right? And that's the lowest yielding portfolio product that we have. Also, clients have used this in a way, if you have a more equity income focused portfolio, where you're typically getting more dividend yield, and that's coming from more value oriented sectors. Typically, you don't get a lot of dividend from growth. Within FEPI, it's roughly 50 basis points of dividends per year. So you're able to have a lot more sector diversification in that sense. I feel like the other piece is we've had a lot of clients and a lot of discussion in the industry at large about the 60-40. Is it broken? And a lot of people are starting to think and rethink, how do we hedge that exposure, which was traditional long-term fixed income or long duration? You can now achieve this through derivative-focused products, whether it's buffered ETFs or using something like covered call ETFs. So a lot of different use cases and can be very nuanced depending on the advisor's goal and the end clients.
It sure can. And nuance can be a good thing too. And obviously with people like you, it makes it easier. If you could you walk us through tax treatment? Are there, these better as far as, in qualified accounts, or can they be used in taxable accounts as well? I know it's going to be an important question with people watching today.
Yeah, absolutely. This is probably, tax usually ends up being a more boring topic for people, but this is actually a
You
really
can
good.
make it exciting.
Yeah, but the tax treatment within covered call ETFs is actually a feature, especially with the way that we've constructed our portfolio. So of course these are great and qualified accounts, but don't think that they're not applicable within taxable accounts also. So the way that this works is you have something called return of capital as a tax classification. So you have capital gains tax classification, and you also have ordinary income or net investment income. Return of capital sounds like it might be a bad term in that, you give me $100, I start giving you $2.1 back per month, and it's your money. That's not in reality how it is actually working or functioning.
Right.
What's actually happening is you are benefiting from tax deferred growth of the distributions. So return of capital, what happens is your cost basis is reduced by the dollar amount that you've been distributed of those distributions that are classified as return of capital. And the actual distributions themselves are not taxable in that current year. So if you are writing options or call options on your own within your portfolio and they're dated less than 1 year, you're paying short-term cap gains on those distributions. So incredibly tax disadvantaged. In an ETF structure, like I mentioned, those distributions end up being tax deferred. So you can either reinvest them and incrementally increase your cost basis, or you can really think about taking that income if it's an older client or somebody who's trying to supplement lifestyle income. And the only time that you're actually paying taxes on those return of capital distributions is when you sell the ETF shares. And so if you've held the ETF then for over a year, you're now paying long-term capital gains. So you have the tax deferral of the distributions, and then you're actually paying a short or a lower tax rate in the future when you sell the ETF shares. Now, there's one more small nuance to this that is really unique, but again, can be incredibly powerful for clients and advisors, is if you are thinking about estate planning and passing these securities on to beneficiaries in the future, you also have the option, or not the option, but the step up, right? And so if those are then been tax deferred, you all of a sudden then have the ETF securities then passed on to the beneficiary. They get stepped up to current market rates. And effectively, you've had a majority of the portfolio being tax free in that sense. So again, nuanced scenario, but one that's really interesting for people to chew on, because you all of a sudden look at this and say, wait a minute, this is incredible. You can really benefit from taxes in this.
Taylor, you explained that beautifully, and I think you just made taxes fun. I think that very few can do that. So you did it, man. It's not an easy thing to do. I want to talk about the option roll process, if we can, Taylor. Is this purely systematic, or does the approach have an active component?
Yeah, it's a little bit of both. I think systematic in the sense that we are writing within all of these portfolios, we have monthly rebalancing of the portfolio to match the index. We also have quarterly reconstitution. But on a monthly basis, what we are doing is we are actually closing out the option positions on the Tuesday before expiry each month. Then we are rebalancing the portfolio to match the index weight. We're pulling out for FEPI 2.1%, putting into cash or T-bills for the upcoming distribution. And then we're restriking options. So from a systematic perspective, in the sense that we follow that process on the Tuesday before expiration each month, it can be active in the sense that we have portfolio managers that are actively identifying the strikes, right? They're certainly using models to identify the correct strikes, but they also have, qualitative inputs that they overlay into the process. But in addition to that, if any of the call option contracts fall in value by over 85%, that's sort of a soft target for us to take a look at the market and take a look at those contracts again and say, does it make sense for us to close these out early and then restrike options to capture more premium within the broader portfolio? So that's kind of a loose threshold for us to kind of step in, take an active approach, and further bolster the NAV of the portfolio. Because within these portfolios, we are soft targeting those 2.1, 2.9, 3.5% monthly distributions that I had mentioned previously.
Taylor, such a fascinating discussion. I can't thank you enough for being here today. Before I let you go, though, I want to ask you, what is next for Rec Shares?
Yeah, so it feels like we're always doing something. We're always trying to push the envelope, continue to innovate. I think we have some really interesting products. We were the first to actually effectively get 2 times leverage within the ETF structure for our single stock leverage and inverse products under the T-Rex brand. For us, I mentioned right now, our biggest focus has been on these single stock covered call ETFs. We now have 4 out there. We have Coin, MicroStrategy, NVIDIA, and Tesla. 3 of those were launched today, or yesterday. So perfect timing for the market there. And then in addition to that, we continue to kind of look and see, does it make sense to expand globally into new markets? What's the appetite for both option and derivative based products? So, very excited to see where we move forward here, but appreciate the time and really had a good time chatting with you today.
Pleasure was all mine. Taylor Ranney, Senior Vice President for Business Development for RecShares. Thank you so much for the wonderful discussion.
Thank you.